thing we did last week that we thought was kind of fun is we decided we would have a meme of the week in honor of our friend the coronavirus. So I'm gonna start off by sharing this this one that we had submitted by one of our clients. Let me see if this works. See if anybody relates to this one. Can you see that? Can you guys see that? Scott, you see that? So
yeah, we see that. That's good.
I don't know if this little meme is actually built into our to our social media platforms or not, but I think I want it. So I'll remind you again, if you come across a particularly funny meme that's PG rated, because I did get some funny ones, but I don't think I would have put them up on this broadcast. Send them along to us. We'd love to see them and get a laugh out of them, and we'll try to throw one of these up each week. But today, I'm really appreciative that one of our team members out of Omaha, Scott Kuby, is agreed to be with us. Scott is a guy with some roots in Texas. I think you were originally, you spent some time down in San Antonio, if I recall.
I went to school at Trinity down in San Antonio. Loved those 4 years.
And Scott's actually been down to our Georgetown office and helped us with an in-person presentation a couple of years ago. And Scott is the senior investment strategist at the Carson Group. We are so fortunate to have the resources right now that we have through our partnership with the Carson Group. And Scott is just one of many examples of that. Scott and his in the team, I'll let him tell you a little bit more about what that team looks like in a second. But it is just so great for us in the trenches here as advisors working with you guys to know that we've got some very, very talented people who are focused on the markets and focused on the macroeconomic stuff, but as well as our specific strategies. And that's the world Scott really lives in from day to day. You guys don't know all the stuff that goes on behind the scenes and what we do for you. But most mornings we are on a call at 7:30 a.m. Scott is often involved in those discussions where we're getting kind of the update of the day. So there's a lot that happens behind the scenes. And I thought, we're having this Wise Counsel Live event each week. And, I don't know, Scott, there's other than interest rates being at zero, oil being less than zero in price, and the world economy pretty much being shut down, there's really not a lot for us to talk about these days. But we thought we'd have you on anyway. So why don't you tell us a little bit about yourself and your typical day in this environment, and maybe a little bit about your team.
I think we can squeeze at least 15 minutes of content out today if we work real hard and stretch. So yeah. I just got finished looking for oil barrels to see if I could store any negative priced oil in, to see if that should be a pretty good deal for me in the long run. Now it's been a really interesting time, I think, from a lot of, and for us a little bit surreal in that Omaha hasn't been particularly hard hit, but there certainly have been a lot of cases all over, and so hoping that you all stay safe as well as up here and all over. And really tracking a lot of that. Generally speaking, a pretty normal day is to get down here. Usually kind of roll out of bed, and the first thing I do is I see what the futures are doing. Honestly, to see where the market's going, because if they're going to be down a lot, it's good to know, because that changes what the call volume is going to be, and that's one of the things that really drives activity quite a bit. Other than that, we're usually down here from about 7 until 5. Unfortunately for you guys, you're not going to get a chance to see my little boy, who's 4, who thinks that every conference call that I'm on is a conference call that he ought to be on as well. But his mother mercifully took him to a full park where you drive around and see animals. And so that was good news. We'll just run until 5, do some stuff with the family, and then usually come back down for another couple hours. And it's really a lot of talking to advisors, working with them to make sure that every allocation is well situated. As we want to make sure that every client that works with Carson through one of our advisors out there is just really well situated. And then a lot of time also just following markets, putting together presentations. Some of the information you see is really where we look at a lot of information and try to distill that down into a couple key insights that we think will matter to you and be able to be at least somewhat remember to give you a quick look of what's going on without having to follow every chart that we look at, which is an awful lot of them.
Yeah. Well, yeah, it has been so helpful. I always come away with an idea or two every morning when we have our sessions. And so again, just thank you for everything you guys are doing. I think you guys were early to go virtual up in Omaha, and this is starting our 5th week, and I think you guys were a week or two ahead of us. So
yeah, I think we're a week ahead. It kind of runs together after a while, doesn't it?
It really does. We're measuring time in terms of jigsaw puzzles now around our house, you know.
Wow, that's get those 2,000 pieces. Those are really harder. They take a lot more time. So
before I let you dive in, I know that clients probably that are on the call probably have some questions. I mean, you can't get into this area without having questions. Unfortunately, because of compliance limitations, we can't take questions live unless you email them to us, guys. So last week we said, email your questions if you have one to Anna. That's ANNAH at wisecounselwealth.com. But if you have any other questions that are more kind of your one-off thing about your situation, obviously just email those to anybody on our team and we'll follow up with you one-on-one. The other thing is, if you have any particular topic that you would like to see us cover in future weeks of this Wise Counsel live session, email those to us as well. I'll tell you at the end of this broadcast today, I'll tell you what we've got on tap for next week. But for now, Scott, I guess you and I'm going to let you walk through some slides. But basically, when we talked about this, I thought, let's give people some perspective. Let's look at, this isn't the first time we've seen volatile markets like this. And there's so many things you could talk about. But, that was kind of the general idea behind this having you on. And so I'm gonna just let you walk through the slides you think are appropriate, and I may chime in, but basically take us through what you wanted to cover today.
Yeah, and just this is part of a larger presentation, and so you'll see me skip a few slides. Don't feel you got too cheated. There's some good stuff back there, but try to pick the ones that I thought would be most relevant for us today. One of the pieces I wanted to share is that if this feels like this has been a very volatile market, it's because it's been a really volatile market. You don't have to look for your psychological reasons like, well, I'm so emotional compared. No, this one has just been as fast moving as you can imagine. This is a chart that shows how volatile the S&P 500 has been on a 2-week basis. What you're seeing is levels that are really at the 3rd highest since 1929. I mean, we're going back to which is crash. Black Monday was actually the peak because that was a very fast downturn. If you compare it to, say, some of the volatility we saw at the global financial crisis, that was extremely volatile as well, but it was spread out over a longer period and didn't quite get to the same degree of movement that we've seen this time. And this isn't on the slide, but in the first quarter, there were 21 moves of 2.5% or more in the first quarter. You go back to 2017, there were only 8 moves of 1% the whole year. So we're talking a whole lot more volatility than we've seen. And some of that is that we get conditioned because of that lower degrees of volatility. And there's a little bit of a whiplash when we go from low volatility to high. And I think we've gotten somewhat used to that. Of those 21 2.5% moves, 18 of them occurred in 22 trading days, which is actually just a day over a month because you start to put the weekends in there, you get up to that 30, 31, and that again shows you the levels of volatility that we've seen. Interestingly, the market hit a peak on February 19th, so it actually hasn't been all that long since we saw that because the market continued to rise up even through the initial stages of the coronavirus being the information flowing out. And until it really started to spread, markets actually were viewing this very positively and thought things were under better control than they obviously were. And so that's really been a big challenge. And so that volatility seems painful. It's something it's uncomfortable. It's disconcerting. It gives us worry. And so one of the pieces I wanted to share here in the minutes that we have is that also, though, that this has been it's an end of an amazing run, but it doesn't take away how effective and amazing certainly the S&P 500 has been. It's been really one of the top, if not the top performing market in the world. So most everything else is a bit below this. But from the low that we saw on March 9th, 2009, all the way up, not to where we are now, but to the low that we experienced in March of this year, that even when you account the decline, the S&P 500 has still risen 15.9% per year, including dividends. And that's a very, very powerful return. And so, you say, oh, I wish I'd been out. Yeah, sure, everybody wishes they'd been out and missed that, but we didn't know. And you didn't know whether it was the trade or any of the other multiple factors. And so the rewards for staying invested, at least over this period of time with the S&P 500, have been really strong. And I always want to say, gosh, short term, this has been a challenge, but long term, there certainly have been the rewards have been well worth it. That's probably 5-6% better than the historical returns that we've seen on the S&P 500. So even with the decline, we still had a really, really good run in markets. I think the other place that we wanted to spend a bit of time is just taking a look at some of the current environment and putting some of the numbers into perspective. And this one, I think this chart's a week old on this one, but it gives you the news was pretty much the same as it had been before, which is job losses have been really, really large. And one of the key phrases that I like to use is that we are going through a self-induced recession in order to prevent the spread of the coronavirus. And the recession that we're going through is a necessary consequence of what the actions are that we're taking on the policy standpoint in order to maintain our health. And so basically we've hit ourselves with a hurricane on purpose. And it really feels a lot like that as a natural disaster, because that's what happened. You think about what happened at Katrina or some of these other ones, is business, everything just gets shut down because there's no business that can be done because of the effects of it. Well, we basically extended that process to a fairly large chunk of the country, really nationwide. And so it's a nationwide hurricane where not only can't people in this narrow area work, but actually lots of people can't because of the restrictions. And so that has created really what amounts to a huge surge in a very short period of time of the number of people claiming unemployment benefits. So basically, we've had 2 or 3 weeks now of really all-time records in a row. Actually, I think 4 of the most number of people claiming unemployment for the first time. There have been 22 million. Although some of those people did find jobs, some of them didn't apply the future weeks. And so there is some back and forth. Also, one of the things about that number, it only measures bad first-time outcomes, and it doesn't measure any of the good side of that. But still, bottom line is the unemployment situation in the United States has gotten a lot worse, and it's really because we've shut down so many businesses. Now, one of the key questions that we wrestle with in this environment is, first of all, who's getting hit the worst? And who is, and what are some things that might help us weather this storm more effectively? So who's getting hit the worst is really service industries. And so I like to compare this back to what we had with the trade wars about a year and a half ago between the U.S. and China. In that condition, manufacturing was getting hit the worst. And if you go back to the financial crisis, we saw that as well. It was stuff to hand. So who was, if you had to imagine the person that was most suffered from the great financial crisis, it would probably be a high school educated male who did some sort of manual work, especially construction, because it was the construction industry that shut down a lot because we had overbuilt, and it really was the knowledge workers tended to bounce back more quickly. In this environment, I would think of a female who is working in a service industry of some sort, especially if they happen to work in a restaurant or for an airline or something like in those employee situations. That's the person that's having the biggest struggle, because these service industries are a lot more reliant on people getting together and interacting. And so when we've pulled that ability back, we've really hit those industries the worst. And so those are very labor-intensive type of businesses when you get down to it. And that's the reason we're seeing so many high unemployment claims. What we're hoping and what we're looking at is there's some of the programs that the government has put in that may be able to stem that tide. And what we're really doing is trying to position it so that when things start to loosen up, and we're in the very early stages of that loosening, as far as trying to open the economy up step by step by step, that we're poised for all those connections and those businesses and the jobs and the interactions are all there in order to allow the country to bounce back economically faster. So what the government's done really hasn't been stimulus as much as it's been designed to sustain, which we'll talk about here in the next couple slides as well. The government support has really been very, very strong. And one of the things that I think has one questions I think people would want to ask is, why has the stock market risen by 25% from the lows until the last couple of days? But it had really gone up quite a bit from the lows. We saw that on the chart, and we've continued to see increases until recent days from that. And why has the market responded so well? Well, remember that the market always looks forward. It is not a backward looking. It isn't, hey, what's going on in front of me right now? It's looking to see how good is the journey likely to be into the future. And what the market is saying is there have been a couple of things that have been very, very effective here. One is the government programs initially were way too small. The one I laugh at is that the president originally proposed $2.something billion, and Congress felt really, really good that they were able to talk them up to $8.something billion. That was the phase one support. That was not well received by the market. Phase two, a little bit better at $100 billion. Phase three at $2 trillion, we finally got enough zeros in the overall support package in order to really say, you know what, the government recognizes that this is a huge problem. Even though there were some kind of fumbles at the beginning, the fact is this is a lot better than what we saw during the financial crisis, where the responses were a lot slower and the policy interactions were less flexible. And so because of that, I think people have felt very positive about that. There are some key parts of this program. One of them is loans to businesses that are designed to keep people employed. I think one of them that's been very well received so far, so well received that it ran out of money, was the small business loans for the payroll protection process and the VAT. And I think that's really one that I think a lot of clients and a lot of people that work with Carson have tried to take advantage of because of that. Bob, do you want to add something there?
No. We've talked many times in many ways about the CARES Act and the PPP loan program, and we've got clients that have taken advantage of that. And I don't know, from day to day, I haven't heard yet if they've officially approved another round of funding for that, but I know they were very close to maybe another 200 to 300 billion, something like that.
Yeah, and I think that they're going to add another 250 plus 50 to the disaster loans, which also had run out, and some other support for hospitals. So actually adding on, really, I called it a phase 3.1, and I don't believe that deal's been passed yet, but I think it's very, very likely to be in the near term, in part because one of the goals of those deals is obviously that you can borrow the money, and then as long as you keep people employed, the loans are very much forgivable. And that's a great deal. If you're in a business that you don't want to let your people go, or you were going to try to pay them anyway, it becomes a lot easier to go ahead and let the government pay for those. And so because of that, that's been a very popular program. And I think that's one example of that. And so what we've really seen is the government support from the Treasury, from Congress, from the administration has been really good. And they would be really, I think, getting, frankly, all-star type votes, except that the Federal Reserve probably has been even better. One of the things that we saw during the financial crisis is the Federal Reserve was somewhat slow to step in and it provide market liquidity. And there is a whole system. We are to take a step back. We are an economy that relies on debt in order to get things done. And sometimes that debt can be really long-lasting, but sometimes it's about moving money between this bank and that bank, and you have to be able to trust the fact that for those 4 hours, you're not going to have the money, but the other bank's going to get it to you. And sometimes those pieces start to clog up as far as how they fund and how they handle some of these short-term loans, between banks and such like that. And so when the market starts to feel stress, then that overall system starts to feel stress as well. It's one of the lessons that the Fed learned very well from the financial crisis is when those stress points start stepping in, that they need to step in. And so one of the analogies I like to use for them is they're really a financial plumber in some sense. And I would guess that none of us worry a whole lot about the plumbing of our house until it stops working. But as soon as it does, it is the number one priority in our lives. And that's really where the Fed is as well. And so what they saw were a number of areas that were slowing down. You know what? The money markets are starting to have some very minimal risk of what they call breaking the buck, where they can't keep their dollar price. And the Fed comes in and says, we'll accept those assets as collateral on our system, and we'll give you cash in exchange for that, which pretty much took care of the problem because they were willing to accept it at face value. And one of the great things about what the Fed does is sometimes they can announce that they're going to do something, And then they don't actually have to even do it before it takes care of the problem, because simply knowing that the Fed will step in is enough in order to loosen up the markets and say, oh, this is going to function fine because we can bank on the Fed stepping in if there's a problem. So now we know there isn't going to be a problem. The Fed doesn't even have to commit hardly any money in order to do that. Where they are committing money and where they really are working to support is to try to magnify the money that the Treasury gets them in order to help a lot more people. And so while the Fed is a financial plumber, they're also the lender of last resort. They are the Bank of the United States in that sense. And so, but they are really functionally prohibited, or just simply from a choice. They don't ever want to take losses on anything they do. And so because of that, if they're going to lend money directly to people and they know there are going to be some defaults, they have to figure out a system to handle that. So the way it works is the Treasury gives them money to absorb the losses, and they take that amount and they magnify it. So in the case of the second bullet down there, the second image, the Treasury says, hey, we're going to give you $75 billion to loan to businesses that don't qualify for that Small Business PPP Act, that are too large for that, but are probably too small to interact with the overall credit markets and be able to go out and get loans, so or sell bonds. And so they're basically reliant on large bank loans. And obviously that can be a big challenge. And so the Fed will step in and essentially purchase those loans from banks who make them, and they're going to leave the banks with 5% of the loan, and they're just going to buy 95% of them at face value. So the bank's got a little skin in the game, and they're going to get some servicing revenue out of it, but what they aren't going to have to bear is the vast majority of the risk associated with it. And so that means that the government will take on $75 billion of losses, but they'll be able to lend $600 billion to businesses. And that means that those businesses now have the money that they're going to need to get through these rough patches, hopefully, in order to get back to the other side when the economy starts to open up and freeing up. And so obviously the duration that loan has to last becomes a very important one. They'll also go in and, for instance, purchase bonds directly from people or directly from the market in order to provide liquidity. There was an example where Marriott was able to go into the corporate debt markets, big company, and sell bonds and get loads more investors for the bonds that wanted the bonds that were actually available for them. How come? Because the Fed had done its job to make sure that people felt that the overall market was liquid, and the federal government had done its job in order to support that business to say, we're not going to let that go under. And so people felt very confident about that. You're seeing the same things with state and local municipal debt and all other areas as well. And so this is a lot of kind of in the detail. But the bottom line is what we're seeing is that the federal government, both through the Federal Reserve and the Treasury and Congress, are all working very closely together in order to provide the bridge that we need from where we are until where we're going to be because of the shutdowns that we're essentially self-imposing on ourselves because of the virus.
Hey, Scott,
so I think yeah, go ahead.
A quick question. I remember back in 08, 09, there was a lot of pushback when the government started talking about the Fed started talking about taking direct ownership in companies and things like that. And this time you've heard rumors of this, and it sounds like it's going to probably happen. I know that topic comes up when we're talking about some of the new opportunity strategies and things like that. And that's one of the things that'll be screened for. But just in general, this is all uncharted territory really for the Fed, right? And so when you're looking at all of that, are we just too close to it right now to really be able to start asking the bigger questions about what is this going to mean longer term? Are we just going to have to get through this and then look on that more in the
and we'll actually we'll dive into that. I think one of the things that we'll see, I'll answer part of that question, then kind of pick it up here a slide or two later, is that the Fed is taking a very incremental approach. And so they don't want to do any more than they have to because they know they're in uncharted territory, and they don't want the market to over rely on it in the future and think, oh, if the Fed's always going to step in anytime there's a problem, then what should you do in the financial markets? You should take a lot more risk. Well, the Fed doesn't want to cause that. They call that, the term for that is a moral hazard, where because I guarantee that everything is safe, then therefore I am not going to be in a situation that I'm going to essentially encourage risk-taking and make a problem more likely than it would have been otherwise. And so the Fed really seeks to balance that. And so the Fed has always been very incremental in trying to do the least amount that it can in order to make sure that everything's working, but make sure that it understands confidence. And that's a difficult balancing act. And I think we're going to see some challenges from that. I think the intermediate time, though, before we jump into those longer term is that we are starting to see the economy start to open up. Texas has been one of those states that has been a little bit more open than some of those that were harder hit up in the Northeast. And it's also starting to open up more, but we're really seeing that trend. Either sometimes the governors are saying we're not opening up, and then they do make these very small incremental adjustments that they don't really announce very loud. But there are a lot of places, both in the U.S. as well as in Europe, and then also China and South Korea are already well into this process of starting to open up their economies. But I want to tell you that there's some risks that we face, especially given how much the market has moved up. The bottom line one is we're seeing this in Singapore right now, is that the number of cases there has started to increase after they did an unbelievably phenomenal job of initially containing the virus when it came out of China, which they had very close relationships with as far as economics. They really shut that down very well. But lately what we've seen is those cases have leaked in from other areas of the world into Singapore, and now they're in a more of an accelerating situation than really a lot of the countries that had got hit very hard. So if we open up and then the pandemic starts to resurge, that would be a very big risk point. I think another thing is that the market seems to be sort of banking on some degree of a medical breakthrough, and I think we're going to get some definite positive steps. I think we have some fairly good visibility in a number of areas. But it doesn't mean we're going to have a vaccine anytime soon. It doesn't mean that the therapeutic is going to be great. It doesn't mean that the vaccine, once it's developed, is going to work for every person every time. And so if we don't get the breakthroughs that we're expecting, certainly some challenges. I think another one is that we may have it where people don't return and go start doing the things they did before, even if the government says that it's okay to, simply because they're worried about the risk. And that may be very prudent. It may be somewhat anxiety, but both of those, either one, that is going to make things harder for them to bounce back. We look at driving patterns in China, and what we're seeing is people are driving a lot more, but they're not taking the subway. And so therefore we know is that the traffic congestion is about the levels that it was before, but we know that there's been a huge transfer of people from the subways to the cars. That means some of the people have gone from the cars to not moving anywhere. But what you see is the driving patterns is people go into work every day, and they work all day and they never leave the office, and then they turn around and they come home and they don't go anywhere. And so that's been the standard pattern that we're seeing within the countries that are ahead of us, big part because they got the virus first. Then obviously challenges with oil, with airlines, and then the other risk that I always want to remind people of is we can have something bad happen that is totally unrelated to this, whether it's a terrorist attack or something where there's some corporate malfeasance or whatever. And I think we'd be very vulnerable. So I do always want to keep people balanced from that standpoint that we've seen a large run up in the market. It doesn't mean it can't go back down. That's fairly common for it to do. It doesn't mean it will have to go back down. It doesn't have to, but it does mean that we have seen some certain risk factors out there that we want to keep in front of people. I think the longer term perspective and changes that we see, and this is really the last slide that I wanted to hit on before we run to one quick one at the end, which is there's a lot of debt burden out there. Not only individuals, but also companies that are borrowing from the government or issuing more debt. Certainly the government's making that available and feasible, but when the economy starts to recover, people are going to be very anxious to repay that, but the government's going to be stuck with an awful lot of debt. And that does raise some questions about our debt burden. It raises questions about future taxes and what those rates are. And I think that's something, Bob, that you're going to be talking to your clients a lot about in coming years is where do we expect taxes to be as opposed to where they are now. We'd say rates are probably pretty low compared to where they're heading. I think also we have to adjust our portfolios to the idea that we're back to 0% interest again. There's no money available in the really short-term super safe. How can I get 3% yield on something with no risk? I don't know, because it doesn't exist out there at this point as low as rates are. And then the other one is, as our companies that we own, the companies of the greatest, strongest companies in the world, especially the industrial side, are very much reliant on supply chains that run all over the world and for trade to be very free-flowing. And right now, I think that there's some risk that we'll see that countries are becoming a bit more nationalistic, and that trend was already established with trade. And so whether you agree with that or not from a policy standpoint, that likely is going to put some pressure on your overall situation in some of the companies as well, as far as which ones win and which one lose from that. There'll be some beneficiaries. There'll also be those that suffer from that. And so these are three long-run changes. I think there are going to be some really big ones to see out of it, but we really don't know what those are. And so the last point just that I would wrap up with is a lot of people are like, investing produces a lot of regret. Oh, I wish I'd done this. I wish I'd done that. I wish I'd moved back into the market at the bottom. If only I'd gotten out right before it went down. There's a lot of if only, if only, if onlys. But the bottom line is, I really would say is I'm a big believer in grace, and I would say in investing, give yourself some. You know what? If you did something that got you off a little plan, talk to Bob and his team about that. That's their expertise, way better than I am. I watch the markets every day, but I do get a chance to interact with people that got off their plan. And one of the things, this is my third major bear market. I've been through the tech bubble. I've been through the financial crisis, this one as well, and a lot of smaller ones in between. The bottom line is I see is that people that do get off plan, they have a lot of regrets and emotions about trying to get back on because, they want to make sure they thought they were right, or they want to be proved right. Problem is, we don't know. I threw a little comment in about a video that we shot right at the beginning of the first quarter, that there's always risk out there. And I mentioned some little virus that was in the center of China as an example. We didn't know, there was a possible risk factor. I had no idea it was going to be as huge as it's been and overall shut down the economy. Neither did anybody else. And so from that perspective, make sure you give yourself some grace to get through those things. Work with the team at Wise Counsel in order to do that if you're in that space, and just don't punish yourself for it. You know what? None of us know where it's headed. That's where this cartoon, we see the guy just looking a little bit discombobulated because he just sold all the stocks that right at the bottom of the market, and that happens. And what he's got to do is get off that rocker and his chair and kind of put it back together and figure out what the plan is going forward. So with that, thanks. I appreciate it. And Bob, I'll turn it back to you.
Yeah, thanks, Scott. There's so much we could talk about. I did want to ask you about one specific area that I've really not heard a lot about. I'd like to just get your quick response to this. We talk to clients pretty often about municipal bonds. They have a lot of questions about that. And I hear very little right now coming out about the impact of all of the behavior change that's happened through this and how it's going to potentially work its way into the municipal financial puzzle, the balance sheets, or the P&Ls, I guess you would say, of the municipalities. To me right now, if there was ever a time to have, to be very, very careful about what types of municipals or even individual corporates or that type of thing, I would think that is a real and present danger that people need to start paying attention to. Does that make sense?
Yeah, absolutely. I think this is a great time to have that extra layer of risk management on top of those. I just think about, I'll tell an Omaha story here. So we have a number of major tourist events that happen in Omaha, at least from Omaha standards. And obviously, so we have our zoo, which is just absolutely fantastic if you ever get up here. It's one of the top zoos, if not the top zoo in the country, but it's shut down. The Berkshire Hathaway meeting is actually a huge influx of people to go see Warren and Buffett. Didn't happen this year. The College World Series is a real big event. We were hosting a Final Four, or not a Final Four, but an opening round NCAA tournament. Well, almost every one of those events was going to take place at an issuer of municipal bonds, because that's, for instance, the arena is an example of that. We also know there's a lot of sales tax revenue. I think what's going to happen is, we've seen some with what the Federal Reserve and the federal government has done so far, is we would expect them to let those organizations burn through a little bit of their cash reserves. But if there becomes a serious issue where there's a municipality that's in deep trouble, there are programs already in place for them to go out and borrow on those. I think the bigger risk is going to be some of those that are more what we call more revenue bond oriented, where it's a municipal bond, but it only gets paid when there's revenue that goes into the stadium or something like that. And that's where I think there is some potential risk. There are also other entities that will issue municipal bonds that are, like it might be a nursing home that's allowed to do it, or a utility that's able to tap into that. And that's one where I think having that extra layer of risk management that you raise is going to be really crucial, because that's where it gets a little bit more certain and uncertain and a little bit more interesting.
Yeah, it's really important that people, I think, don't just kind of buy into general indexes as much as they might have gotten away with in the past. They really need to be very careful. And it's one of the reasons I'm so grateful that we've got our investment strategies that are, we've got some that are index based, but we've also got many that are owning and researching individual securities, individual bonds. I just think that we're going to see in the days ahead, my experience, this is my fourth major event I've lived through, if I throw in 87. I just think the days ahead, it's going to matter more than usual that you've got specific analysts looking at specific holdings, because there's just all kinds of ramifications that are going to kind of work their way through the economy as a result of shutting the economy down for 2 months now, and who knows how long this is going to go on.
Right.
So anyway, well, look, thanks so much for being here, Scott. Again, we could spend hours talking about all kinds of things, but we wanted to try to keep it to about 30 minutes. I want to remind everybody that we're going to be here again next Tuesday at noon. We've got Jamie Hopkins, who's another great resource partner of ours through the Carson Group. He's the director of retirement research with Carson. And I asked Jamie, I said, look, Jamie, we talk often with clients about this simple idea. We try to make the complex simple. Let's think of our money in three different categories, or three buckets. Bucket one would be money I need now, potentially cash type stuff. Bucket two would be something I need later or soon. And then bucket three would be later. And it kind of helps, I think, simplify things when we think of it that way. And I thought, let's take a session and let's think about things that would go into that bucket one that would be now money that aren't necessarily obvious. And everybody knows money in the bank is cash in the bank would fill into that bucket, but there's a lot of other ways you can look at that. So we're going to be digging into that next week. If you have any suggested topics, again, I'll remind you, just email anybody on our team. And also, if you find a particularly funny meme related to these interesting times we're living in, send those to us and it might show up next week. Scott, I really, really appreciate everything you and your team are doing. Thank you for your time today. And
thanks for your trust as well. Thank you.
Oh, absolutely. And with that, we'll wrap it up. Thank you so much. We'll talk to you guys next week. Bye-bye.